Hello guys, welcome to Formulating Finance. In our channel, we discuss everything related to finance and also the practical aspects about how some of the concepts are applied in real life. In today's video, we would be discussing about exchange traded funds, also known as ETF. In simple words, it is a fund which has a pool of securities which can be easily traded on stock exchange. ETFs are set up with an objective to give returns that is equal to underlying index. Index can be of anything, such as a popular equity index Nifty, Sensex, or any other asset class or a commodity. For understanding perspective, in this video, we are taking up Nifty as an underlying index. But Nifty 50 or Sensex is not easily traded on stock exchange. Then, how to earn the appreciation in them? Should we invest in all its constituents? Is it feasible to invest in 30 or 50 stocks? I don't think so. To let investors earn such objectives of passively earning returns, ETF concept was introduced. ETFs hold same constituents and in approximately same weights as its underlying index. If index gives 12% weight to Reliance Industries, ETF2 will give 12% weight to Reliance Industries in its asset holdings. Let's see from investors' perspective. It is just a fund trading on stock exchange. It can have anything as its benchmark, say gold, PSU banks, commodities, currencies, or any asset class which can be invested in. And one can start investing by buying just one unit of ETF. Some of the ETF available in India are SBI Nifty ETF, ICICI Prudential ETF, Kotak Nifty ETF, Birla Sun Life Nifty ETF, and many more. Now, let's compare ETF and mutual funds. Mutual funds traded on stock exchange, so we don't need any demat account. For ETFs, we need demat account. Mutual funds claim that they will outperform Nifty returns, so they charge more fees. ETFs charge less fees as they are passively managed and will simply track Nifty index. Investors will have to pay brokerage fees to buy and sell units of ETF. For mutual funds, investors pay entry and exit loads, making ETF cost efficient. ETFs are not prone to investment errors. For redemption and subscription, one has to connect with mutual funds house. For ETF, one has to trade it on a stock exchange. Benefits of ETF. It is diversified as it holds basket of securities present in its underlying index. Such an index has constituents from different sectors such as oil and gas, financial services, information technology, etc. Nifty ETF will have 50 stocks. Sensex ETF will have 30 stocks. As it is a passive way of fund management, as you don't have to keep track on every single investment your ETF owns. The fund manager ensures that portfolio resembles the benchmark index with minimal difference. It has a low cost of acquisition as it can be purchased in multiples of one unit on listed stock exchange. The biggest advantage of investing in ETF is cost efficiency. The expense ratio of an ETF is usually very less, that is 0.5% if we compare it with other funds. A lower fund management fees generate savings which can result in increased payouts in the future. Since ETFs are marketable securities, they can be traded on stock exchange, thus making them liquid investments. And ETF can be bought and sold during the trading hours, which cannot happen in mutual funds or PPF. And it is a transparent way of investment. As ETFs track an underlying index, you know beforehand which stocks it will hold and in what proportion. For example, if Nifty 50 is composed of the 50 largest listed companies in India, an ETF tracking the Nifty 50 will hold the exact companies and in the same weights as its Nifty. Limitations of ETF. Demat account is necessary. Since ETFs require demat account and trading account, investing in them is not practical for investors who do not have such accounts. There's very less chance of extra returns and upside growth on benchmark. As the constituents of Nifty are large cap stocks, their upside potential is limited and they are in limelight. In contrast, one can invest in non-constituents and can earn higher returns such as mid caps or small caps, as it is being passively managed. So investors have to give up the aspirations of earning better returns than Nifty. One example of ETF traded in India is Axis Nifty 50 ETF. Here is a list of Nifty constituents and its weight. If you check, weights and constituents are very similar to Nifty 50 benchmark constituents. Now, let's see sectoral representation of Nifty. Financial services 34%, oil and gas 14 to 15%, infotech 14.17%, and so on. Let's compare it with Axis Nifty ETF. Financial services 34%, oil and gas 14 to 15%, infotech 14.1%, and so on. If you compare, it is mostly same and is very well tracking Nifty. But as an investor, my objective was to earn return in line with the underlying index. So let's compare the performance. Axis ETF had a negative return of minus 11.73% last year, whereas Nifty also performed negatively and delivered minus 11.51% return. But over the larger period, when returns are positive, Axis ETF has earned similar returns too by mirroring the benchmark in its strategy. Thank you everyone for watching the video. I hope you understood the simple concept of ETF. Please like and share the video and subscribe to my channel Formulating Finance.